Wall Street made over $263 billion in profits last year, while the average investor barely kept pace with inflation. I remember checking my own portfolio and feeling that familiar disappointment. Maybe you felt it too. In this video, I'm going to expose the 5 biggest myths the financial industry doesn't want you to know about. I'll break down each myth using real data and provide actionable alternatives. By the end of this video, you'll have the knowledge to stop letting Wall Street profit from your hard-earned money and start taking control of your financial future. The third myth will challenge everything you thought you knew about investing. Myth number 1. You need a financial advisor to succeed. Have you ever wondered how much of your investment returns are actually going into someone else's pocket? The answer might shock you. The financial industry has spent decades convincing us that without professional guidance, our investment portfolios are doomed to mediocrity or worse. Those slick commercials featuring retirees sailing into the sunset, all thanks to their trusted financial advisor, are incredibly effective marketing tools. Those impressive financial offices with marble floors and fancy coffee machines tell an important story. The luxury surrounding you isn't funded by investment genius, it's paid for by your fees. Financial advisors operate under fee structures that often remain hidden in plain sight when you sign up. Think of financial advisors as toll booth operators on your investment highway. At every mile marker, they collect a little more of your money. Here's what these fees typically look like. Annual management fees, 1 to 1.5% of your total assets. Transaction fees for buying and selling investments. Performance fees for market gains they take credit for. Together, these can total 2 to 3% of your investments annually. This might sound small, but the impact is enormous. Invest $100,000 for 30 years with a 7% return, and you'd have $761,000 without fees. Pay 2% in fees, reducing your return to 5%, and you'd end up with only $432,000. That's $329,000, almost half your potential wealth, gone forever. Most fee disclosures are buried in dense legal paragraphs on page 27 of a 30-page document. Advisors know clients rarely read these carefully, allowing them to collect substantial fees without scrutiny. The real problem? You're paying premium prices for predictable underperformance. Studies from S&P Dow Jones indices consistently show that 85 to 90% of professional fund managers fail to outperform their benchmark indices over a 15-year period. There's also a fundamental conflict of interest in how many advisors are compensated. When they earn commissions on specific products, their recommendations inevitably tilt toward what pays them more, not what's best for you. This explains why you might be steered toward certain mutual funds or insurance products with higher fees, regardless of performance history. Consider that variable annuity your advisor enthusiastically pushed. It likely carries fees exceeding 3% annually, and surrender charges if you need your money early, plus a handsome commission for the advisor who sold it. What's the alternative to this expensive arrangement? A remarkably simple approach consistently outperforms most professional management: low-cost index funds. These funds, which simply track market indices rather than trying to beat them, regularly outperform 80–90% of actively managed funds over longer time periods. Myth number 2. Active management beats passive investing. Those index funds I mentioned aren't just a good alternative, they're at the center of Wall Street's second big lie. While the financial industry showcases star managers with impressive short-term wins in glossy brochures, they're hiding a mathematical reality that makes consistent market-beating performance nearly impossible. The numbers tell a completely different story than their marketing. Let me explain how active management actually works. When you invest in an actively managed fund, you're paying for a team of analysts and portfolio managers researching companies and making strategic decisions about which stocks to buy and sell. They have Bloomberg terminals, proprietary algorithms, and prestigious degrees from top universities, all focused on outperforming the market. This sophisticated operation costs you significantly more. Active funds typically charge 5 to 10 times higher fees than passive options, 0.75% to 1.5% annually compared to just 0.03% to 0.25% for index funds. Think of it like buying a luxury sports car for your daily commute. Impressive features and higher costs, but ultimately less efficient for the actual journey you need to make. The historical record shows these higher costs rarely deliver better results. Wall Street would rather you didn't notice this pattern. What's worse, fund companies often quietly close or merge poorly performing funds with better ones, creating survivorship bias. It's as if they're taking a test throwing away wrong answers and claiming perfect scores. Even funds with impressive 5-year track records typically regress to average performance later. A top 10% performer from 2010 to 2015 is statistically no more likely to remain exceptional in 2015 to 2020 than any random fund. Past performance, despite the constant reminder in fine print, truly doesn't predict future results. The mathematics are surprisingly straightforward. The stock market operates as a zero-sum game. Before costs, for every investor who beats the market, another must underperform. Once you factor in those higher active management fees, trading costs, and potential tax inefficiencies, it becomes a negative-sum game. The average active investor mathematically must underperform by exactly their extra costs. To see the real impact, a $10,000 investment with a 0.1% annual fee versus 1% makes a dramatic difference. Over 30 years with 7% market returns, that seemingly small fee difference means about $20,000 less in your retirement account. Money that went straight to fund managers instead of funding your future. Myth number 3. You need significant capital to start investing. That hidden fee calculation should be enough to make anyone think twice about traditional investment platforms. But there's a third myth Wall Street perpetuates that keeps countless potential investors on the sidelines entirely. The idea that you need thousands of dollars just to get started. How many times have you heard someone say, "I'll start investing when I have more money"? This belief keeps many people, especially younger ones, from investing during their most valuable years. Take Sarah, for example, a teacher who started investing just $20 per week from her first paycheck. After 15 years, her small, consistent contributions grew to over $25,000, all because she didn't wait to have enough money. Here's the truth Wall Street doesn't advertise. You can start building wealth with just $5 a week. That's less than the cost of a fancy coffee. Thanks to compound interest, those small weekly contributions could potentially grow to over $100,000 during your working years. Traditional brokerages reinforce this barrier, with high account minimums and fee structures favoring larger investors. A $7 trading commission on a $100 investment immediately puts you 7% behind, making investing seem inaccessible to many. The investment landscape has completely transformed in recent years. The emergence of micro-investing platforms has democratized access to the market. Services like FinHabits now allow you to invest with as little as $5, no minimum balances, no commissions eating into your small contributions. These platforms offer fractional shares, letting you own portions of companies like Amazon or Apple with whatever amount you have available, like buying a slice of pizza instead of having to purchase the entire pie. This accessibility works perfectly with dollar cost averaging, consistently investing a fixed amount at regular intervals. When you invest the same amount regularly, you naturally buy more shares when prices are low and fewer when prices are high. This approach can outperform lump sum investing in volatile markets by removing the pressure of timing the market perfectly. The psychological benefits are equally important. When investing becomes automated, you remove the emotional decision-making that often sabotages returns. Set up an automatic transfer of $20 per paycheck, and you'll be investing consistently without the stress of market timing. One client started with $100,000 but committed to adding just $1,000 monthly. By retirement, this disciplined approach is projected to grow to $1.2 million. The principle remains the same whether you're adding $1,000 or $10 per month. What makes these modern platforms powerful is their simplicity. Many traditional investors get overwhelmed by market complexity, but these tools make the process straightforward. Pick a goal, set up automatic contributions, and the platform handles everything else, including diversification across appropriate investments for your goals. Myth number 4. Complex investment strategies yield better returns. The simplicity of modern investing platforms stands in stark contrast to Wall Street's fourth major myth, that complex investment strategies yield better returns. Think about it. If the most sophisticated investment products really outperformed, why would they need such complicated names and opaque structures? The reality is much more concerning. Let's look at structured notes, Wall Street's favorite complex products to sell to everyday investors. These instruments come with appealing marketing terms like principal protection or enhanced yield. Behind these labels lies a labyrinth of derivatives, hidden fee structures, and risk profiles that even professionals struggle to understand. These products are designed primarily to generate profits for their creators rather than for you. When purchasing a structured note, you pay premium fees that aren't clearly disclosed up front, significantly eroding your potential returns while creating substantial profit margins for the issuer. The 2008 financial crisis provides a sobering lesson about complex investment products. Mortgage-backed securities were marketed as revolutionary, safe investments, until they weren't. When the housing market collapsed, these complex products imploded, causing catastrophic losses for investors who didn't fully understand what they owned. Many lost their retirement savings and college funds in the process. The complexity didn't just hide risks, it amplified them. Warren Buffett, arguably the most successful investor of our time, summarized it perfectly. The stock market is designed to transfer money from the active to the patient. His approach emphasizes simplicity and long-term thinking over complexity and constant trading. This preference for simplicity is backed by research. Studies in behavioral finance show that complexity creates confusion, especially during market volatility. When investors don't understand what they own, they make emotional decisions at precisely the wrong moments, often selling during downturns. The alternative? Simple portfolios consistently outperform complex ones over time. A straightforward mix of low-cost index funds, diversified across different asset classes, delivers strong returns with lower fees and greater transparency. These simple portfolios are easy to understand, maintain, and adjust as your financial situation changes. Consider this striking example. While hedge funds employ some of the most sophisticated investment strategies in the world, a basic portfolio of index funds has outperformed the average hedge fund for 11 consecutive years. These complex funds charge enormous fees, typically 2% of assets plus 20% of profits, yet deliver inferior results compared to simple index investing strategies. In investing, complexity often becomes the enemy of good returns. Myth number 5. Market timing is essential for success. After exploring the dangers of investment complexity, let's turn our attention to what might be Wall Street's most seductive myth: the idea that timing the market is essential for investment success. The S&P 500 drops 5%. Is it time to sell everything? Such headlines bombard us daily. The financial media constantly serves up market predictions, technical analysis charts, and expert opinions about the perfect time to buy or sell. The premise is alluring. Who wouldn't want to buy at market bottoms and sell at peaks? But here's what Wall Street doesn't want you to acknowledge. Market timing is virtually impossible to execute consistently. The stock market responds to countless unpredictable variables: economic data, geopolitical events, investor sentiment, and random noise. Trying to time the market is like attempting to predict where lightning will strike next. Consider this eye-opening statistic. Missing just the 10 best trading days in the market over a 20-year period can cut your returns by more than half. That's just 10 days out of roughly 5,000 trading days, determining whether your investment journey succeeds or disappoints. This reality leaves many market timers constantly anxious, second-guessing every decision, and ultimately underperforming the market. Even Warren Buffett admitted during the 2022 annual shareholders meeting, "We've not been good at timing." Jack Bogle, founder of Vanguard, put it more bluntly: "The idea that a bell rings to signal when to get into or out of the market is simply not credible." Remember the 2008 financial crisis? Despite warning signs in the housing market, very few predicted the severity or timing of the collapse. Those who did make accurate predictions often failed on their next call, predicting continued doom while markets unexpectedly recovered. The psychological aspect makes market timing even more challenging. Our emotions, particularly fear and greed, frequently lead us to make exactly the wrong moves at exactly the wrong times. We buy when markets are rising and sell during steep declines, the opposite of successful timing. Peter Lynch observed, "I can't recall ever once having seen the name of a market timer on Forbes' annual list of the richest people in the world." That's because market timing doesn't create sustainable wealth, it undermines it. When attempting to time the market, you're not just fighting unpredictability. You're incurring additional costs that eat into returns. Transaction costs, taxable events, and costly timing errors driven by emotions. The alternative? Understand that time in the market beats timing the market. The most powerful force in investing isn't predicting market movements, but allowing your investments to benefit from compound growth over long periods. Now that we've uncovered these 5 costly Wall Street myths, let's focus on what actually works for building wealth. The evidence is clear. A remarkably simple approach consistently outperforms expensive, complex strategies. Choose low-cost index funds tracking diverse market segments, Set up automatic contributions to enforce dollar-cost averaging. Commit to buy and hold through market fluctuations. The power of this approach is stunning. A $100,000 investment in a diversified portfolio could have grown to over $347,000 in just the last decade, wealth that would otherwise be diminished by Wall Street's complex, fee-heavy alternatives. Tools like FinHabits can automate this process, making consistency simple. Take action today. Review your current investments and implement these principles. Share your Wall Street experiences in the comments below. Remember, while Wall Street profits from complexity, your financial future thrives on simplicity and consistency. That's it for today. If you enjoyed watching this video, please don't forget to like and subscribe to our channel. Thank you.